Most people would agree that when you get into trading or investing, it's probably better to have some kind of a game plan. However, in reality, less than 20% of traders have any form of strategy at all, and those that do, it's generally no better than a buy or sell signal flagged up by an indicator. The majority are just looking for high probability entries as a basis for their entire trading approach. Couple with that a flawed understanding of exits or position sizing, and they're virtually guaranteed to have a negative expectancy, even if they do master the skill of trading with discipline. The missing piece of information in that equation is that they fail to understand the trading concept that they're actually trying to follow. Get to the bottom of that one and all of a sudden your strategy has a solid foundation to sit on. In this weekly series of videos, we're going to look at a full range of different trading concepts, highlighting the advantages and disadvantages so that you can zero in on the approach that's right for you. This week, we'll kick off with one of the most simple and recognizable trading concepts that's been around since markets were invented, and that is trend following. Some of the most successful investors of all time have been trend followers. It can be a very lucrative way to trade once you understand how a trend works and you know what you're doing. Let's break down exactly how this concept works. Now, it might seem obvious, but there's actually two parts to understanding trend following. Firstly, there is the concept of trend. Without some kind of price movement, we can't make any money. Markets don't move in a straight line. The simplest definition of an uptrend would be a sequence of higher highs and higher lows. For a downtrend, that would be a sequence of lower lows and lower highs. We all need prices to move. If there's no trend after you buy, you can't sell later and expect to make any money. The second aspect is the bit where you follow the trend. Now, there's a little bit more to this than you might first think. When we say following, what we're actually saying is that the trend followers as a group watch and wait for the market to start turning. They look for a shift in the price action and then they act upon that change. They see the turn, take action and follow the move. Trend following indicators can be used to help determine when that shift has happened. Parabolics, standard deviation, ADX or just good old-fashioned moving averages are all effective trend following tools and widely used by traders in finance. Once you're in the market, the idea is to then sit back and ride out the move. Trend following also works well with the old trading adage, cut your losses short and let your profits run. The ideal situation for a trend follower would be to be in a move that never ends. However, in reality, all trends do reverse eventually, and when they do, a trend follower is always looking to cut their losses short and maximize their profits. There are 5 key advantages to being a trend follower. Firstly, it's a super simple concept to understand. It's pretty hard to miss a major move, and trend indicators will usually give you a good signal that the market has turned. It works for all asset classes. In Forex, for example, bigger picture currency trends can last for years. If you focus on the longer term changes in trend, you can reduce your costs. The amount of trades that you do is lower, and that can really have an impact on your bottom line. The profits can be outsized too, and quite often, if you jump on board a major move, one single trade can make your whole year. As a result, it's a concept where your strategy doesn't need to have a high win rate, as your average winners will far outstrip your average losers. But what about the disadvantages? Well, trend indicators are good at showing you that there's been a change in direction, but they aren't that good at picking out the really good trends from the mediocre trends. You can get conflicting signals, and a build-up of small losses can be off-putting, especially for new traders who might lose confidence and abandon their strategy. Trend following also requires a lot of patience. Markets only spend around 15 to 25% of the time actually trending, so you have to be prepared to sit, watch and wait, which can be a little frustrating at times. Finally, trend following is not really for scalpers or day traders. It can be harder to manage your risk and balance transaction costs, as you can't let your profits run if you have to liquidate your position at the end of every trading day. So finally, after all that, is trend following a trading concept that you should consider? Absolutely. Trends are a critical part of finance. Without them, we'd have no sense of organisation and prices would just feel and seem like random noise. Out of all of the different trading concepts that you can use as a foundation for your trading, there are few out there that are as profitable and successful over the long term as trend following. Next week, we'll look at the advantages and disadvantages of using fundamentals as a backbone of your trading style.